Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us back today is our good friend Patrick Karim of North Star and Bad Charts. Welcome back, Patrick.
Hi, Ivan. Hi, Jim, man. Also, always good catching up with you guys.
Yeah, it's an absolute pleasure having you back on Wall Street Silver. So, Patrick, all of a sudden, the legacy media this week they came out and they're talking about gold and silver. Jim Cramer says gold is a buy over crypto. Silver and gold is down a bit. Are they purposely doing that? What's going on, Patrick?
Well, look, he should have said this crypto thing. He should have said it back in 2021 when they were pumping it, and he should have said it in 2022 when it was breaking down. So for that, it's on him. Like he's saying it when the price of Bitcoin is actually rallying up. So that's kind of Jim Cramer style. Sorry, Jim, I don't know you, but it's like I know it's a running meme on his. He's always doing the opposite. But for gold and silver, there could be a pullback right now because gold and silver they're hitting breakout lines. I'll show you right after this. So he could be right that there could be a pullback in the precious metals right now before the true launch. So gold, silver, they are vulnerable until they can close above the breakout line. So I think he's more right that gold and silver are close to launch. So the charts do agree because eventually that's very possible. But for Bitcoin, he's wrong right now because there's a rally, but eventually it will probably topple over. For me, it's like a bear market rally for all these spec tech stocks. So yeah, the media, look, guys, they could spin any story any which way. I would never trade on any type of contrarian indicator on that. Just look at the charts and you'll see the truth, man.
So what are you seeing short term now, Patrick? Are you looking for it's like on the silver charts, are you looking for a pullback?
Yeah, I don't know. Maybe it's a good time to share my screen there. So just give a little visual support. So yeah, guys, look, silver, it's really trying to, it actually it got back above its 3-year moving average, its 1-year moving average. It got a really scare here below the 3-year, but it's making a run. It's in a bullish transition zone. So as soon, like 27, $28, like as soon as it clears that, there's a reverse symmetry move. So every time there's a huge base and there's what I call launch platform, a horizontal breakout line, the price oscillates. And once it breaks convincingly above those lines, it's like the market saying, okay, that fair market value, something's changed. It's detaching it from it. You could call it manipulation, price suppression. It's gone. Somebody flips the script, and then price rockets the same angle that it did on the way down. So if ever it closes above 28, we're going to probably have a fast move all the way to 35. And once it closes above 35, we're going to have a rocket move. Like this is going to go nuts above all-time highs and over. And if you don't believe me, this recipe has happened over and over. So here's the 1980s top goes ballistic, huge base. I'll just draw a horizontal breakout line here. As soon as it breaks from the horizontal breakout line, fast reverse symmetry move, mimicking what it did previously. And this happens over and over again. So right now, silver is pretty much like 2002, 2003, 2001. The US equities are rolling over. They're below their important moving averages. And as soon as the markets start sensing the monetary imbalance is required to nominally save those US equities, gold, silver, oil, like insert your favorite commodity and they're going to go bonkers.
So you're looking for 27, is that what you said?
Yeah, look, a convincing close on a monthly close above 28. So let's say we get a monthly close at 29.50. Man, it's like don't second doubt that it's over there. It's going to rocket to another $7-8 like in the blink of an eye, and it's probably going to be within all-time highs within 6 months if ever that happens. But it's all a question of patience right now. So Jim Cramer will be right once.
Well, you were speaking.
We gotta show that. We gotta show that meme on the screen of our the tweet on the screen of the Jim Cramer article.
Yeah. And Patrick, you were saying you have insights too on commitment of traders for gold and silver. That we were speaking about that before we recorded. Why is this important?
Okay, commitment of traders, guys, is it's available data on the CFTC. It's how the speculators, the commercials, they hedge all their position size. But what I like to look at is the small specs, non-reporting small speculators. And you'll see gold. This is the gold chart. And I'm just going to get my tool. That yellow line, guys, is the yellow line is the net. So it's all the longs minus the shorts. The green is the longs and the red is the shorts. So when the net is below the total shorts, it's a bear market for gold. You see it here during all of the 80s gold market. When the net is above, it starts climbing above the total shorts, you're in a bull era. So I see that yellow line, as long as it stayed above the total shorts, then we're in a bull era. So the money's coming in, money's coming in.
Right.
Here, bear market repeats over again. This is the bottom base. Then we had the explosion here that brought us the gold back to all-time highs right above here. And recently during the pullback, I'm going to zoom in for you guys right here.
Oh, it's switching back.
Yes, exactly. So here was the huge drawdown. It's about to overtake the total shorts. And you could even do some classical TA on this, or just like regular trend line. That's, you know what I'm going to call this?
Jim Cramer. Jim Cramer is right.
Jim Cramer's right above this line. So I'm so sorry, Jim.
Inverse Cramer, inverse Cramer's now broken.
Yes, I'm so sorry, but anyways, I like it with you guys because I can make these jokes. It's fine, you know. But this is objective weight of evidence. I'm just seeing how the position of the commitment of traders behaved with previous price action on the gold chart. So if this turns back up here, man, you got to start getting bullish because this could be in the cards, this huge move here. And if I do silver, it's practically the same thing. Well, look at silver's above, actually, it's total shorts right now. And if the total longs can break out on their, what's happened right now in the past 2.5 years, guys, it's a full reset of momentum. It's a full reset of, I'll show you here even, you see how the volume picks up here and the price goes up. Usually the huge volume, you have some good volume on the breakout, but when everybody starts talking about it, fear of missing out, the volume is high because everybody's trying to pile in, right? The crowd. And then after that, when the price breaks down, the volume resets. And look what happened here. So here the volume, 2015 lows, all the way to the craziness of July 2020. Then what we've had in the past 2.5 years was actually a reset in volume, which is great because this is fuel for more silver squeeze, for more craziness, you know, more when CNBC starts talking about us, blah, 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 all that will, it shows that technically there's room for that to happen. Now, we're not stretched by any means of the imagination based on the volume, even for silver. So this is a great setup, guys.
Whenever we start getting bullish about silver, you know, I start getting replies on Twitter and people start saying things like, oh, wake me up when it's 30, wake me up when it's 28. You know, is that a key technical point? You know, 28, that seems to be like where we spent a lot of time in 2021. You know, after the peak at 30, we were in that 26 to 28 range a long time. Months. Hold on, there it is. Technically, what happens at 28 or 30? You know, what is it like smooth skits? What are you expecting?
Right.
Well, I'll show you what happened on the gold chart. So on the gold chart, here is the move it did. So we kind of see the future. The gold chart, this was a top of the bull market end top. It's what I call a wall. So previous support, once you're below it, it's resistance. Gold, when it broke out convincingly here in January of 2020, before the March Madness, guys, look, you see it's a wick. Even during March Madness, before the whole markets broke down in that COVID panic, gold was at 1,700. It went all the way down to 1,450, but by the end of the month, it had barely moved. It had broken out 2 months ahead above this wall. So that's the equivalent. Gold breaking out above 1560 in a convincing manner is like silver breaking out above 2050 in a convincing manner. And look what gold did. It went bonkers and it just overshot above all-time highs within 6 months. So when I say silver is going to reach all-time highs within 6 months, it could even be faster because silver has a faster nature. I'm not basing that out of just randomness.
Yeah, just the volatility
previous evidence. This is what I'm expecting for silver once it breaks out above that wall, that critical 2011, 2013 parabolic melt up at the end of a bull era for commodities. Once it's able to, the market says, okay, man, it's good. It's gonna go nuts. Not much is going to be able to stop it for as soon as it closes above 28 there. It's going to be a rocket ship. If there's no rocket ship, then it's not legit TA, guys.
There we go. You put a rocket ship. Now it counts.
Okay, well, don't worry. Our editor will insert a rocket ship at this point.
Yes, with animation.
Yes. So
Yeah.
Patrick, we were talking before we record about the debt levels too.
Yes.
31.5 trillion plus. It's exploding upwards at an exponential rate. And the only way for the federal government to continue to, they just got to keep piling up on these bills and borrowing more on credit. Is there a point where this turns into a black swan? What's your opinion, Patrick?
I used to have a chart where I had total debt, public debt multiplied by the Fed fund rate. And that total number was at all-time highs. We're above the total debt saturation of the 2000s, of 2018. We're skyrocketing now because the rate's at 4 or 5% multiplied by total public debt. It's like we're levels we've never seen. But then I decided maybe we should be measuring total public debt by gold. Gold tracks inversely your purchasing power. So that means that it's a US dollar adjusted for inflation. So the more inflation there is, the more inflation erodes your US dollar strength, the more gold is going to appreciate versus that. So what I did is I took the total public debt and I priced it in gold. And I just want to see historically how far the total public debt can extend itself from the total gold value. Because my theory was total public debt, there might be no limit. People might say, oh, 40 trillion is a lot, 60 trillion is a lot. Just like when we said it was 4 trillion, people say, of course it's always a lot. Because look, the total public debt, guys, it's this line here. It's a black line. It's always been going up. At any stage here, people could have said, the debt's too much. The debt's too much. It never went down practically. It's always been going up. So you have to measure it in a ratio. You have to measure it relative to something else. A lot of people, they measure it relative to GDP. That's a common. But I said, let's measure it in gold. And we're back here when the total public debt started going down, measuring gold. It was when gold started going ballistic in 2018. Here was the 99, 2000 .com bubble. And right here, it broke out and it's going back down. Now it's a false breakout. Those are very powerful. And there's a rising trend line here, paradigm shift breakdown line, 1, 2, 3, 4, 5, 6 touches. If ever, I zoomed in here, if ever we close below that line, that means there's a huge reprice in gold. The market is gold's going to go bonkers because now the only way they could keep that debt high where it is or increase that debt is by destroying your purchasing power and by inflation. And the more they destroy your purchasing power, gold is a perfect reverse image of destruction of purchasing power. So by association, you say if they destroy your purchasing power to prevent a total collapse or to keep increasing that black line up, then gold has to go up the price. It has to. It's like when I saw that chart, I said, okay, unless there's total debt default, unless debt actually vanishes, but you've seen for 40, 50 years, debt has never vanished. It's just been piling up at different rates of acceleration. Gold's price has to go up. I can't say they have to let it go, like as they is who is like that conspiracy thing, but the market will price gold in accordingly. And each time gold has appreciated versus that total debt. So every time the total debt went down, pricing gold, this was huge precious metals bull era in the 70s. Here was this was the US equities bull era, huge precious metals bull era when that thing unwinds. And we're just about to start a new one, guys, a new leg in 10 years of precious metals going bonkers. Am I allowed to say bonkers?
Yeah, of course you are.
So I don't know what other words to put in there. It's like, but that line has to be breached. That silver chart I showed you has to close above 28 convincingly. That gold chart has to break out. But guys, this is a takeaway. We're closer to a breakout than a breakdown. So I don't get these guys who are always doomsayers, deflations.
Yeah, it's trendy. It's trendy to be a doomsayer.
Well,
it's an easy tweet to make, right? It's an easy tweet to make. Is you guys are full of it. I've been waiting for 10 years.
Yeah,
basically.
Okay, well, it's fine. But if you look at charts, there was no reason to go long gold or silver when U.S. equities broke out versus gold. When total public debt started breaking out here in the 1982 versus gold, you step aside. That's telling you, the market's telling you there's room for more debt as priced in gold. So gold was so expensive in the 1980s that it created this huge cushion for the Americans, the US, to expand their debt because gold was already had priced in all that debt. But now we're hitting saturation levels last seen at the .com bubble. For me, in my eyes, guys, I've looked at 100-year charts. The .com bubble is the bubble of all bubbles in the US equities. I don't care. Like when you price it in gold, that is the bubble of all bubbles. What we've had today, even if nominally NASDAQ is way higher than it was in the .com, it's in real terms, we've never had a bubble as big as a .com bubble, never.
Mm-hmm.
And that's hard to understand there when I tell a lot of people that the real bubble was about 20 years ago. And now nominally, even if the US equity has been going up, the destruction of your purchasing power has been going up faster. So you think you're getting richer, but essentially you're getting richer at a lesser rate than you did prior to the .com bubble.
Exactly. So Patrick, any last words before you head out?
Yeah, well, look, guys, the lesson of this is no matter what your fundamental story is, the narrative, that's all fine and great. But at the end of the day, we can only trade and make money off the price chart. You have to get in at a low risk, high reward entry, and then ride that trend all the way up, no matter what our story is, no matter what we think of whatever, because everybody has a story. Everybody has billions of dollars behind their stories, but it's the aggregate of all these stories that you'll see in the price chart.
Mm-hmm.
And hopefully I get to share some of that clarity there via my charts to all your audience.
Well, yeah, we seriously appreciate you coming down to Wall Street Silver, and then hopefully we can have you back in 3 months and silver's at $30.
That'd be awesome.
That'd be great. All right, take care, Patrick. See you guys.